$5,000. Gold is sitting right there, right now, on the single most important trading day of this quarter. And here is what is strange about it. Every condition that should be pushing gold down is active today. The dollar is elevated. Treasury yields are holding above 4%, and the Fed is meeting as we speak. In any normal market, that combination would have gold trading closer to 4,800. Instead, it is sitting at 5,000. That tells you something important. And that is exactly what this video is about. Last week, I told you to watch the US dollar index, specifically whether DXY could hold above the 100 level. I said if it breaks below 100 and stays there, that removes one of gold's primary headwinds, and the metal gets structurally stronger. Here is what happened. DXY peaked near 135 and then retreated. As of this morning, it is trading at 99.50 to 99.61, below 100. That call landed. And now the setup it created is exactly what we are dealing with today. My name is John. I spent 15 years working inside currency and commodity markets before I started making these videos. I have sat in rooms where these decisions get made. I have watched what happens when retail investors get the wrong information at the wrong moment. That is why I am here. This channel, Currency Insider, exists because the people watching their savings from home deserve the same quality of analysis the institutions are getting. If that is what you have been looking for, hit the like button right now. It tells me to keep making these. And if you are not subscribed yet, now is the time because what we are covering today is part of a bigger picture we are building week by week. Everything I show you today comes from publicly available sources. I will name every one as we go. Today we are covering 3 things specifically. Why gold holding 5,000 under current conditions is structurally significant, what the Fed decision this afternoon actually means for the metal, and what the Iran war is doing to the macro picture that most channels are getting wrong. So let me give you the market picture as it stands right now. Gold is trading between $4,998 and $5,013 per ounce this morning. It is straddling the 5,000 level like a fighter who just took a big punch and is refusing to go down. Silver is sitting at $77 to $79 per ounce. The gold-silver ratio is approximately 62 to 1 right now, and I want to come back to that number later because it matters for silver holders specifically. The US dollar index is at 99.50, holding just below that 100 threshold. 10-year Treasury yields have edged down to just below 4.21% as traders position ahead of the Fed decision this afternoon. The FOMC rate decision comes at 2 p.m. Eastern today. Powell's press conference starts at 2:30, and this is Powell's second-to-last public appearance as Fed chair before his term expires in May. Every word he says today is being parsed for clues about the transition and what comes next. Now here is the question this video answers. Why is gold not selling off today? Because by any conventional framework, it should be. Let me break down what is actually happening here across 3 areas: the Fed, the Iran war, and the physical market. Because each one is playing a different role in this picture, and you need to understand all 3 to read today correctly. Start with the Fed. The consensus expectation today is a rate hold at 3.5 to 3.75%. That range has been maintained since the 3 consecutive cuts of late 2025. Now here is the thing. The hold itself is not the news. The market has priced that in. What matters today is 2 things. First, the updated dot plot, the Fed's own projection of where rates go from here. If the dot plot signals no cuts until late 2026 or even 2027, that is hawkish and gold faces short-term headwind. Second, Powell's language around inflation and the Iran war. Crude oil is trading above $94 to $100 per barrel right now. Iran has been striking energy infrastructure across the Persian Gulf. Think about what that means for the Fed's job. They are trying to manage inflation at the same time an active military conflict is keeping oil prices structurally elevated. That is a textbook stagflation setup. Higher oil means higher transport costs, higher manufacturing costs, higher food costs, everything that feeds into the inflation number the Fed is watching. And if inflation stays elevated because of geopolitical factors outside the Fed's control, they cannot cut rates to support growth without looking like they are abandoning the inflation fight. That is the trap Powell is sitting in today. Think of it like a thermostat on a wall that someone keeps overriding from outside the building. You can set it to whatever you want inside, but if the door keeps blowing open from outside, the temperature never stabilizes. That is the Fed right now. The door blowing open is Iran. So what does gold do in a stagflation trap? Historically, it does very well, Because stagflation means your currency is being eroded by inflation, while your economy is being slowed by high rates simultaneously. In that environment, gold is not a speculative trade. It is a store of value performing its primary function. The last time the market saw a genuine stagflation setup at scale was the 1970s. Gold went from $35 an ounce in 1971 to $850 by January 1980. I am not saying we repeat that. What I am saying is the structural logic that drove that move is not absent from this market. Now let me talk about the Iran war specifically, because this is where I think most channels are getting the framing wrong. Treasury Secretary Scott Bessent has said the U.S. is allowing Iran to continue shipping crude through the Strait of Hormuz. That sounds like de-escalation. But here is what is actually happening underneath that headline. Iran has intensified attacks on energy infrastructure. U.S. allies have rejected Trump's call to secure commercial shipping through the strait. So you have a situation where the U.S. is saying we are not blocking Iranian oil, but the infrastructure that moves other energy around the Gulf is under active attack. That is not a contained conflict. That is a managed escalation. And markets that are pricing this as a temporary risk premium are potentially underestimating the structural impact on oil. If oil stays above $94 for the next 6 months, every inflation forecast in the Western world needs to be revised upward, and every rate cut timeline gets pushed out further. Gold understands this. That is part of why it is sitting at 5,000 today, when the traditional suppression factors are all present. If you know someone who has been watching gold this week trying to make sense of the moves, share this video with them right now. This breakdown took time to put together, and the people who need it most are probably not searching for it. Now let me bring in the physical market picture, because this is the layer that the paper market analysis misses entirely. The Shanghai gold market is continuing to price physical metal at a premium to COMEX. That tells you that Asian institutional buyers are not waiting for dips. They are paying above the international benchmark to take physical delivery now. Central bank buying, particularly within the BRICS framework, has not meaningfully slowed despite gold being above $5,000. Think about that for a moment. These are not traders looking at a chart and deciding when to buy the dip. When a central bank reallocates reserves into gold, that is a multi-year institutional decision made by committees. They do not look at the price action on a Tuesday morning and change their mind. The World Gold Council data has consistently shown this buying trend continuing at pace throughout the current price cycle. And here is the part that matters for UK investors specifically. The London Bullion Market Association, the LBMA, remains the global benchmark for physical gold pricing. The vault activity in London is a real-time window into institutional physical demand. When LBMA vaults are showing sustained withdrawal rather than deposit, that is the physical market telling you something the futures chart cannot. It is like watching a reservoir. The price of water on the paper market might say one thing. But if the actual reservoir level is dropping every week, the structural reality is different from the quoted price. That divergence between paper pricing and physical delivery reality is the defining feature of this gold market right now, and it has been for the past 18 months. Now let me bring in the broader geopolitical layer, because this connects everything we have just covered. The US dollar index trading below 100 is not an accident. It reflects a specific set of pressures: the Iran war uncertainty, the fiscal trajectory of the US government, and the ongoing shift in how central banks around the world are thinking about dollar reserves. I'm not going to tell you the dollar is collapsing. That is not what the data shows, and it is not what I believe. What the data shows is a dollar under measurable structural pressure for documented and verified reasons. The Congressional Budget Office has been publishing projections on U.S. deficit trajectory that are not comfortable reading. The math of compounding interest payments on existing debt at current rates is getting harder to ignore. De-dollarization is a decade-long structural process. It is not a Tuesday event. But the direction of travel is visible and documented, and the Bank of England's own reserve data shows the same trend playing out in the UK context: a measured, gradual institutional reorientation toward hard assets as a reserve component. That is not panic. It is portfolio management at the sovereign level. For British investors holding gold in a SIPP, a self-invested personal pension, the LBMA benchmark price matters directly. When the LBMA price is being supported by the same structural forces we have just described, that is not a short-term trade. That is the macro environment doing exactly what hard asset holders have been positioned for. And connected to all of this is the industrial picture for silver, because silver is both a monetary metal and an industrial one. And right now, the industrial demand layer is adding a structural floor that did not exist in previous cycles. The Silver Institute data shows silver demand from solar panel manufacturing continuing to scale globally. AI hardware physical requirements, the connectors, the semiconductors, the cooling systems, all contain silver in quantities that are not trivial when you multiply them across the scale of the build-out happening right now. Silver is not like oil where you can watch it burn. It is hidden inside electronics, connectors, panels, medical devices. It is everywhere, and it is rarely recycled perfectly because it is dispersed in tiny amounts across massive industries. The UK's own North Sea energy transition is adding to this picture. Offshore infrastructure, grid connectivity, storage systems, all silver-intensive at scale. I am not going to give you a precise ounce per megawatt figure because that would be false precision, and you deserve better than that. What the Silver Institute data shows is the direction of demand, and that direction has not reversed. All right, let me show you how I am actually thinking about this week using the 3 lanes framework. This is how I separate what is noise from what actually matters. Lane 1, the paper market. Futures positioning in gold has been elevated but not extreme. The CFTC Commitment of Traders report shows managed money net longs, the hedge funds, the professional traders, are positioned long but have room to extend if the Fed delivers a dovish message today. The key risk in the paper lane is a hawkish dot plot triggering forced deleveraging. That would be the short-term pressure scenario. Lane 2, the physical market. COMEX registered inventory has not collapsed, but withdrawal activity has been consistent. Shanghai premiums remain positive. The physical lane is telling a quiet but persistent story of real demand at real prices. Lane 3, macro, dollar below 100. 10-year yields just under 4.21. Fed meeting today. Iran war ongoing, oil above 94. That is a macro constellation that historically has been constructive for gold. In 15 years watching currency and commodity markets, the times I have seen all 3 lanes align in the same direction, even briefly, have historically been some of the most significant moments in these markets. I am not saying we are fully aligned today. The paper lane has a binary risk event this afternoon, but 2 of the 3 lanes are pointing in the same direction, and the third depends entirely on what Powell says in 3 hours. When the paper lane is carrying binary event risk, while the physical lane is showing quiet, sustained accumulation, and macro is pointing toward structural gold support. The historical pattern has been that the physical reality eventually wins. That is a framework, not a forecast. You decide what to do with it. Here is the one thing I am personally watching this week. One thing, the Federal Reserve dot plot, released today at 2 p.m. Eastern alongside the rate decision. Specifically, I am watching whether the median dot for 2026 shows 1 cut, 2 cuts, or 0 cuts. 1 or 2 cuts, dollar weakens, gold sustains above 5,000, silver gets a tailwind. 0 cuts or a push to 2027. Dollar strengthens, gold tests 4,800 to 4,900 support. Silver underperforms short term. The dot plot is published by the Federal Reserve directly. It is public the moment it drops. You do not need anyone to interpret it for you. Count the dots for 2026 and see where the median lands. That is the number. This is my one call for the week. John, FX Insider, on record. I will be back next video to tell you exactly what happened. No edits, no excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is where most channels pick a side and run with it. I am not doing that today. Here is what needs to happen for the optimistic picture to develop. Powell delivers a dovish hold this afternoon, acknowledging stagflation risk from oil while signaling the Fed will prioritize growth. The dot plot shows at least 1 cut in 2026. DXY weakens further below 99. Gold breaks above 5,050 and closes the week higher. Asian physical demand absorbs any paper selling in the short window after the decision. That is the bull scenario, and it is genuinely possible. Now here is what needs to happen for the cautious picture instead. The updated dot plot signals no cuts until late 2026 or 2027. DXY rebounds back above 150. 10-year yields rise back toward 4.28%. Gold pulls back to 4,800 to 4,900 support. A sharp risk-off move tied to Middle East escalation initially lifts gold before triggering speculative profit-taking as leveraged longs exit. That is equally possible. Both outcomes are live right now. Your job is not to pick one and emotionally commit to it. Your job is to watch which conditions are actually developing in real time this afternoon. The dot plot drops at 2 p.m. Eastern. Powell speaks at 2:30. The market will tell you within 30 minutes of that press conference which scenario is unfolding. You just have to be watching the right things when it does. Before we close, the disclaimer you need to hear, and I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the two questions, if you got value from this today, the like button takes 1 second and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. I want to ask you two things and I genuinely want your answers, not just a thumbs up. First, are you holding gold, silver, or both right now? And did today's price action change anything about how you are thinking about your position? Second, watching the dot plot drop this afternoon, what is your read? Does Powell go dovish or does he stay hawkish to protect the inflation fight? Drop both answers below. The comment section here becomes a real-time sentiment tracker, and I read every single one. Subscribe, because next week we are going into what happens after a Fed binary event resolves, specifically how to read the 48 hours of price action that follow a major Fed day, and what signals actually matter versus what is just noise. That is a framework worth having. And if someone in your life is watching their stack right now and feeling confused about what is happening, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market. Protect your currency.